Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, June 22nd, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. Please do your own due diligence. I am not a financial advisor. I cannot give you personal financial advice. It's your money. It's your responsibility. Okay, so again, we have recent Purchasing Managers Index June flash report for the U.S., and it's positive. So again, we get this continuing stream of contradictory economic news here in the U.S., where we have some data that comes in that's negative, and then we have other data that comes in that shows positive. And so, for example, the PMI, I'm a big fan of PMI. Purchasing Managers Index, and here's what the Flash Index said, or the Flash report said. The headline S&P Global Flash US PMI Composite Output Index edged higher from 54.5 in May to 54.6 in June, its highest since April 2022. Output has now risen continually for 17 consecutive months, with the pace of expansion having improved markedly in May and June. So not only has it improved, it's the pace is expanding and improving. And so that's positive. Anything above 50 obviously shows expansion. So it's hard to really get a handle on this macro situation. You know, again, the reason why I'm curious about it is because I would like to understand when the timing of a possible rate cut in the U.S., the U.S. central bank being the biggest bazooka, monetary bazooka out there. You know, we're seeing more and more of the central banks in the G7 cut rates, and, you know, the U.S. being the biggest. I think eventually we get there, but, you know, when you see things like this, with the stock market at all-time highs, with real estate prices at all-time highs, with the economy, with this kind of data coming in, you really can't be cutting rates, right? You can't justify that. Anyways, the another blurb from the report, June's expansion was led by the service sector, where business activity grew at a rate not seen for 26 months. Services activity has now risen for 17 straight months, recovering strongly in the year to date after the near stalled picture seen in late 2023. Buoyed by rising demand, inflows of work into the service sector rose at the sharpest rate for a year in June, driven mainly by rising domestic demand. There you have it. So again, contradictory information. One piece of information is good, another piece is bad. You can't get a good reading of the pulse of the economy and where that's heading. Maybe it's just going to take a situation where, as global PMIs improve, that we see a increase in oil prices or energy prices that would lead to a recession. I don't know. You know, forecasting this stuff is a mug's game. I've learned my lesson on that. But again, we would like to at least look at what the current information is and try to get a handle on when we would see the Fed cutting rates, just because, again, that has so many spillover effects into where the dollar would be, the effect on gold, commodities, emerging markets, all these things. So anyway, that's it. You know, then you look at, here's an example. You know, this is why you got to look at things, as much data as possible, not just focus on one or two things. Here is what they call the Citi Economic Surprise Index. And what you see here is it's in sharp decline. And typically what you see, what this person has done is has superimposed the 10-year bond yield on top of it. And you see that the bond yield typically tracks fairly closely the the surprise index. Obviously, if the economic surprise index is increasing, indicating better economic growth, you see bond yields rise because that could be possibly inflationary. What I want to point out here is this very large gap that's developing as the surprise index decreases. This got a lot of attention this week. And, bond yields are declining a little bit, but not a lot. And there's a potential there. I think, if the economy is actually weakening and you're going to see rate cuts, don't forget the possibility that bonds can be, or longer duration bonds can be very profitable in a trade. Obviously, the longer you go out in duration, if yields come down, the price of the bonds goes up. So you can conceivably, if you're in a rate cutting cycle, you could conceivably, the typical rate cutting cycle being 400 or 500 basis points by the Fed in the past, throughout its history, you can see a tremendous capital gain if you buy bonds. I don't advocate people go out and buy bonds and hold them to duration. These are certificates of confiscation. I mean, inflation is going to be a problem over the next 10, 20, 30 years, whatever, until we deal with this debt situation. But in the short term, you can get virtually a risk-free yield. And when they do cut rates, you can see a pretty good capital gain, 20, 30%, depending on how far they cut rates. So I'm looking at this. I do have a lot of cash in T-bills and some in 2-year notes. And I do this via mutual funds or ETFs. I'm considering going out further on duration, but again, you have this bifurcated economy and you don't really have a sense of where it's really going. So I don't know. I'm still thinking about it. But they do say that the bond market is actually a lot smarter than the stock market, and you will actually see bonds react well in advance of stocks if you are going to have an economic slowdown or recession. Wanted to point this out from Jesse Felder. NVIDIA market cap bigger than market cap of France, Germany, and the UK, not together of each individual country. So you have NVIDIA now with a market cap over $3 trillion. And here's the market cap of the UK stock market, the French stock market, and Germany. So I would ask you the question, if you are a contrarian investor, if you are a value investor, if you don't like to buy overvalued things and you like to buy things that are undervalued or relatively speaking, if I gave you the choice over the next 10 years that you had to buy and hold NVIDIA stock, or let's put it this way, you could have all the stock in NVIDIA, 100%, or you could have all of the stocks in the UK market, or choose one of these other three. I would rather have all the stocks in the UK than I would just NVIDIA. I mean, we've seen this before. This is not sustainable. Yeah, this is a bubble. We've seen this before many times. And we're seeing the same. I talked about this in a couple of interviews I had. I have nothing against NVIDIA. I have nothing against folks that have made money on this. It's outside my circle of competence. I don't really mess around with tech. I don't know enough about it. It's too rapidly changing. You really, in my view, have to have some expertise. So what you have is a lot of punters and bleacher bums that are riding the wave, and that's cool. I mean, hey, I don't begrudge people that win the lottery or walking down the street find $100 bill. It is what it is. But can you get these type of returns? Can you get lucky like this through multiple market cycles? Can you do that over a decade? Well, that's a different story. And, I'm seeing the same type of excuses, the same type of rationalizations, the same type of arrogance that we've seen in the housing market in 2008, that we saw in 1998, 99, 2000, the tech bubble, what I've read about in, the Nifty 50 stocks and other bubbles. It's the same psychology. It's the same rationalization. So it will go on. Maybe Nvidia goes to $6 trillion in market cap. No one knows. Anything is possible. But I can tell you that I'm happy to put up any amount of money, $10,000, $50,000 in escrow, that I guarantee you that 10 years from now, Nvidia will not have a $3 trillion market cap. Well, I shouldn't say that, because if we have a certain inflation, it could. Let's put it this way. I think this chart will not look like this. I think it'll look like all the other rocket ship charts we've shown of previous bubbles. You'll see this thing have an apogee, and then it will roll over, and then be priced correctly, because the business just can't. It's the law of large numbers. And you're looking at a country like the UK. It's such a value now. The valuations in the UK are so low. One of the stocks I picked up in my dividend portfolio in the Actionable Intelligence Alert newsletter is a very large bank in the UK. Look, the European banks, I've talked about this before, they're very cheap. They're horribly managed, or they have been. Some of them have new managements. But they haven't made any loans really in like the last 10 or 12, 14 years. And so when interest rates went up in Europe, their net interest margin has went up greatly. It's kind of like, idiot sons and widows just clipping coupons. So the managements haven't been making a lot of loans because they've been recovering from the last financial crisis still. And so they just have all this net interest income and cash flow. And so what have they been doing? Buying back stock. They're overcapitalized. They've been buying back stock. They've been paying dividends. And that's what we're looking for. We're looking for ways to compound our wealth. I don't need them to go out and make a bunch of loans, but you can look at the stock charts of your major European banks, and they're all in uptrends. They're doing very well. They've broken out of sideways action that's gone on for years. And so, there's other companies in the UK. There's consolidation, mergers and acquisition happening there. Another, in the dividend portfolio, I have in the another a large, integrated international oil company. I mean, it's has new management, or a new boss, new CEO, who's the former CFO, and he's talking about increasing cash flow and returns to shareholders. This is what I want to hear: share buybacks and dividends. So in a dividend portfolio, that's just a brief side conversation on the dividend portfolio. One of the unique things I did with the dividend portfolio, or I'm looking at from my own perspective, because I am getting close to, retiring from work. And so I wanted to create an income stream. And you can go out and buy like the Dividend Champions ETF, stuff like that, an ETF where they buy stocks of companies that have raised their dividends for, decades. I mean, Procter and Gamble, stuff like that. I'm not necessarily interested in that. What I was interested in is dividend companies with a possible upside kicker due to the business being turned around, or in a unique situation, or a contrarian thought. So not only do I see in my dividend portfolio increase, they're not necessarily dividend champions, but they're companies that are paying, the yields are anywhere from 7 to 20%. And there's opportunity in the business. If the business improves, if the managements do what they say they're going to do, you can get an actual, upside kicker and a capital gain. So I think that's a little bit riskier, obviously, but I kind of like that. And I'm certainly not going to go into the bond market. I mean, to stay ahead of inflation, you're going to need some of these. And a lot of these companies I'm invested in would be in the dividend portfolio. The Actionable Intelligence Alert dividend portfolio would be companies that are in natural resources extraction that I think are going to benefit from the inflations we're going to see from the debasement of paper currencies over time. And they will be able to at least match or stay ahead of the inflation that I think we're going to see. You certainly don't want to be in a government bond. right? Because you have no upside kicker, you have no increases in dividends, you have no buybacks, you have no increasing cash flow to compensate you to help you stay in front of inflation. So yeah, I kind of got off track a little bit there, but there are opportunities in these countries. I own an oil company in France. It's doing very well. It's in areas that I want to be in, like offshore Namibia, and it's same situation. So this was a tweet. Oh, I forgot the guy's name now. I should have wrote a note down. But anyways, this was a guy. I forget the guy's name. Um, I'll put a link to this article that was from 2000. This is a guy that was like a institution, William Detmer, I think. I can't remember. You'll see it in the show notes. But what I put up here is blast from the past because this was an article that was written about valuations of the tech sector and growth stocks in 2000. And similar language, it's similar uh, justifications and rationalizations, as I said earlier. The article is great, and I'll put a link to it. And you can read it. But just here's a few blurbs. Now, remember, this is from like 2000, but you'll notice that it's echoing kind of what you're hearing nowadays. So it says, during my now 36 plus years in this business, I've never seen anything even remotely comparable to the current chasm in the stock market between new economy and old economy stocks. The NASDAQ, which rose 85% in 1999, has risen another 16% so far this year, while the Dow Jones Industrial Average was recently off more than 14%. But it is not the unprecedented market chasm that prompts this piece. It is the accompanying arrogance on the part of all too many new economy, aggressive growth managers, as demonstrated in such things as the writings of James Cramer on TheStreet.com and the utterances of seemingly endless parade of hedge fund managers on CNBC. So he goes on to give an example of a previous bubble in the Nifty 50 in 74, 75, echoing the same thing, showing what happened, showing charts. So what I'm trying to convey to you is that the psychology, the FOMO, the greed, the same principles are at work because human nature doesn't change throughout time. The name changed. I mean, this guy is still on Twitter, but at the time, 24 years ago, he had a 36-year career already. So the guy had the mileage. That's why I bring up these things that I saw in the past, these previous uh, bubblicious conditions and how they end. And so he comes to the conclusion, again, if you're interested in these things, which you should be, take a look at this article. I'll put a link to it in the show notes. And it's important to look at these things because the same outcome's likely going to happen this time. And so here's the conclusion to this guy's article. As I said at the outset, what prompted this piece is the arrogance on the part of all too many new economy growth managers who sneeringly tell everyone who is not invested in the same Ciscos and Qualcomms as they are that, quote, this is the way it is and this is the way it's going to be from now on. The old economy stocks are relics of the past, and if you don't own the Ciscos and Qualcomms of the world, no matter what the price, you're living and investing in the past, not the future, unquote. Again, we are not about to quarrel with the idea that Cisco is a better company than, say, Sears. It is. But investors are not buying Cisco, the company. Investors are buying Cisco, the stock. And what seems to be lost on the part of many money managers is the fact that just because Cisco is a better company than Sears does not automatically make Cisco a better stock too. And so that's the point I've made. Now, if you go back, there's a reason why this is. Money managers, people that run money, they're judged on their performance. Their bonuses are based on their performance. They don't have 3 to 5 year timelines like we do in the Actionable Intelligence Alert newsletter. As I have said before, the style that we have is to take a longer term view on things, and we don't have a board or an investment committee or investors that have given us money that are breathing down our necks on a quarterly basis. Okay. So we're able to be patient. That's one of our fundamental advantages being an Actionable Intelligence Alert subscriber. We have the patience and the long-term view to let ideas play out. And this is why everybody crowds into these things, because they have to. If you don't own these mag stocks and you're a portfolio manager and you're underperforming, you're going to get called to the carpet. Why don't you own these stocks? And you say, well, the old economy stocks, I sell for valuation and buy undervaluate. They'll fire you. You will be fired. This is why this stuff happens on Wall Street. Now, you don't have to do that. You can outperform, being an active investor, and outperform by doing what? Going against the trend. But you have to have some patience. You have to understand that psychology to a bit. You have to know yourself, and you have to be prepared to ride out periods of boring underperformance or no performance where stuff just goes sideways and then all of a sudden launches. Look at a long-term chart of uranium prices. What happened? Sideways, 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 boom, breaks out, goes higher. I just mentioned the European banks. Go look at Commerce Bank, Unicredit, some of these other banks. Look at their charts for the last 15 years. They're breaking out higher now. I'm just using those as examples of what, sometimes you just have to wait it through. And so one of the things I'm trying to do to hone my skill set is kind of wait for those breakouts after those long side to sides, because you don't want to sit there. There is an opportunity cost to sitting in something where nothing's happening. And so that's what I use technical analysis for a little bit, not to predict stock prices, but to try to see something that I already have a fundamental contrarian interest in, and then, just put it on the watch list. And then when it looks like people are coming around to the idea that this is a situation and money's coming in and it breaks out, then take the position. That way, you're better off just sitting in T-bills and waiting or something else until this action happens. And so what I wanted to point out here is back to the first blurb here where he says, I've never seen anything even remotely comparable to the current chasm in the stock market between new economy and old economy stocks. Excuse me. One of the things I'll point out, this is where I made a tremendous amount of money because I had gotten long commodities. I didn't, resource stocks as this NASDAQ thing in 2000 rolled over. And you will note if you go back there, as the NASDAQ plummeted, I don't know, 80% or whatever it was, a lot of value stocks and resource stocks and old economy choo-choo train industries went up massively. And so are we at the same point now? It's very possible. Again, I'm not a fortune teller. It's impossible to know with certainty the future. But I think the setup and the similarities are the same, or very, not exactly, that it's never 100%, but very, very close to being the same. And so I wanted to point this out because I thought this was a tremendous article. The point I try to make is, I make these declarations or proclamations. Oh, yes, I've seen this before, but here's another person that really, this article is really good to look at because it gives you the data and it's something to think about when you're making your capital allocation decisions. So anyway, I will put a link to it and you should check it out. This guy actually is still alive that wrote this article. I mean, he already had 36 years in the market in 2000. So he's retired now, but it would be 60 years now. So this is the kind of people I like listening to because experience does matter in these things. Having a historical perspective. I mean, anybody can be a Johnny come lately and not understand that what has been will happen again. There's nothing new under the sun. And here we go, right? The top 20 tech companies in the world, they're nearly 18% of total global stock market value. I mean, 3.3 trillion for Apple, 3.3 trillion for Microsoft, 2.2 trillion for Alphabet, 3.2 trillion for Nvidia. So, I mean, there it is. There's some other foreign companies here, SAP in Germany, ASML in the Netherlands, which, makes chip making equipment, China has Tencent. There's other companies here, South Korea, Samsung. So basically the big dogs here in the US. So out of the whatever $200 trillion a year in global GDP, these 20 companies represent 18% of the total global market value. I don't know. It seems concentrated to me, but what do I know? And again, here's what we see at tops, right? Here's what we see at possible inflection points. We see the largest weekly inflow ever to US growth funds. Okay. Is this a top? Possibly. Uh, does that mean things can't get more bubblicious? Yes, they can. I don't want to be owning growth stocks when all of the bleacher bums are coming in at the end. This is classic, red alert, take your profits, go sit in T-bills uh, type of action. And so I put this here. I don't say this I just be, to try to make a point, because this is what happens at tops, right? Are all the shoe clerks and taxi drivers in the market yet? Here we have household stock allocation at an all-time high. These are indications of tops. Not necessarily that next week's the top. Doesn't mean it can't go nuttier. Anything can happen. But we see in the past, if you want to look at the previous tops, when the people that know the least are in, they're the last to know. Again, I go back to the quote that Don Cox used to say when he was at BMO. He was a historian. He was a market commentator, analyst, very, very wise man. He was a historian by trade. And he said that you should be looking at the page 16 story that's heading for the front page. If you're looking at the front page and making investment decisions, front page of the newspaper I'm talking about, if you're looking at that, then the move has already happened. You're already late to the party. And this is what typically happens, right? Retail investors, the average person, kind of the same thing where you have, Rockefeller being given or JP Morgan being given stock tips by the shoe shine boy. Yeah, it's kind of maybe time to get out. Again, this doesn't mean it can't go higher. This doesn't mean that we won't see more bubblicious conditions, but you're really running in front of a steamroller picking up dimes at this point, in my opinion. And so here's GMO's forward return forecast. Again, U.S. large and small cap stocks. Here's emerging value in emerging stock markets. This is where it is. That's where the action is in emerging debt. So these things are going to fluctuate monthly, but we've seen the constant trend month after month where U.S. markets are overvalued, emerging markets are, and international small cap at least is positive, the forward returns. So take it or leave it. So I wanted to talk about this. A lot of people were talking about it this week. I've been talking about it for a while. Where the CBO came out and projected $50 trillion in debt by 2034. The other news this week is that the revised deficit for this year, the deficit in this country where the economy is doing so well, $2 trillion. $2 trillion. Okay. And so we haven't even had a recession yet, folks. If we have a recession and all the automatic spending that comes in for unemployment and food stamps and Medicaid and all of the what they call stabilizers or shock absorbers come in, what's the deficit going to be? $3-4 trillion? Again, this is not a problem until it's a problem. And this is why the average person doesn't pay attention to this or doesn't understand this, because again, it's not necessarily actionable on Monday morning. You've seen other debt crises around the world. What happens? People go home from work on Friday. All the banks, the central bank closes all the banks over the weekend, and they don't open up on Monday. And then you're in a middle of a crisis, and then it is what it is. I'm not suggesting that's going to happen here. What I'm suggesting to you is that this is not tenable long term. This is another thing I've been talking about. It's coming closer and closer. A record 9.3 trillion US federal debt will mature and must be refinanced at much higher rates over the next 12 months. This is up a massive 4.7 trillion or 102% in just 4 years. This comes as the US Treasury switches to issuing shorter dated maturity securities. So again, 9.3 trillion, a lot of it that's at substantially lower rates. This is why interest expense on the debt is exploding higher and is going to be a problem going forward as it becomes one of the largest budget items on the federal budget. You're just paying, you don't, like one person said, you don't even own the underwear you're wearing. You're making minimum payments on your grocery bills that you put on your credit card. This is the kind of stuff that, people that live chaotic, undisciplined lives go through and what banana republics and emerging markets go through. This is where we're heading. This is not strength. This is not an America that, and there's no plan to fix this. There's nobody in the Congress. There's neither presidential candidate is willing to talk about this. It's just going to continue kicking the can down the road until you kick it up against a wall and the whole thing breaks. Then you have a, uncontrolled demolition of the financial markets in the U.S., which will probably have ramifications on the dollar, and the U.S. is standing in the world as one of the top economies. Now, again, is this going to happen next week? No, but it's coming. It's coming. I don't see anything out there politically that's going to change it. And I don't even see anything on the horizon, even if you get past these two geriatrics. I mean, this is the kind of like the old Soviet Union. As a matter of fact, our leadership is even older than the old Soviet leadership that people used to make fun of. I mean, Pelosi's over 80, Biden's over 8, he's 81. Trump, I think, is in his late 70s, pushing 80. I mean, this is what we have for so-called leadership in the U.S. And so this isn't going to work. And again, both Mr. Biden and Mr. Trump are MMTers. They just want to spend money. And the Congress is going to oblige it, with the exception of a couple people in Congress, or maybe Rand Paul in the Senate and a couple people in the House. No one talks about this. No one cares about it. There's no constituency for cutting spending. So here's a visualization of that debt that needs to be, that's going to mature. You see how it's kind of accelerating recently. Yeah, we'll see how it plays out. It's kind of striking, right? How this has exploded. So I wanted to point this out because I talk a lot about long-term investing and psychology and your mental makeup when you're trying to build wealth. And so on the left, you'll see something that you'll see at your Edward Jones financial advisor's office, or some people will show you. If you put this much money in and you get an average return of 8%, this is how your $280,000 will grow to 1.6 million over 30 years, blah, 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 which is true. You're just looking at the combined annual growth rate, the compounding. Compounding does work. It's a wonder of mathematics. It works. Okay. The problem is the reality is actually on the right. These are your annual returns from 1872 to 2022 on the S&P index, where you have up years and you have a lot of down years. And here's the problem. Because if your psychological makeup is not correct, if you don't understand this over here, the volatility, and what happens is people buy here. They don't just put 288 a payday in and forget about it for 40 years. What they do is they actually look at their statements, they look at the market, and they want to buy here and they want to sell here. They're greedy here, they're fearful here. And that upsets this whole apple cart over on the left. And this is why people don't accumulate wealth, or a lot of people don't. They don't understand. They're not psychologically understanding or capable of riding through. I mean, Charlie Munger said it. He would look at this and say, what's the problem? If you're not able to withstand a 40 or 50% drawdown in your stocks, then you shouldn't be in the stock market. Because wise people that are long-term actual investors, not speculators, not gamblers, they understand math, okay? And they can control their psychology when they have volatile markets. And so I think it's important to really understand this, because the goal should be, as an investor, is to compound your wealth over time. Yeah, you can get a one-shot deal on some of these tech stocks or over a year or 2 years as they go up, but can you do it consistently? Do you have the psychological makeup to take losses? You know, even top investors like Druckenmiller only get their picks right 40 to 50% of the time. And so the ability to allow winners to compound, allow companies to compound wealth, you know, and trimming off the losers and then just holding and letting these businesses grow, this is hard, right? Because especially with smartphones, how easy it is to make trades, all of these things, okay? The cost of trading is very low, so it encourages churning, it encourages trading. And the average person is not set up to be a trader. This is why I recommend for most people, yeah, you shouldn't subscribe to my newsletter and you shouldn't be an active investor. What you should do is understand this chart on the left and put money into like a world portfolio. Create a world portfolio based on the GDP of the, of the world. If the US is 24%, then put 24% of your money in an S&P Vanguard fund with uh low expenses. Then get a world fund for the rest of the world or something like that, right? And then just leave it alone. And then you will compound at, 8% a year, whatever the average return has been, which is shown over here, like 8.4% over from 1872 to 2022, and you'll be fine. But, people cannot stand listening to their coworkers say they made so much money in Bitcoin or in Nvidia or with this whatever stock tip, and they think to themselves, this guy's a total moron. He's making all this money. I can do that too. Okay. So there's a difference between getting lucky on some tip or whatever you're doing, speculation, and then doing it consistently over time to build wealth. And that really should be your goal, is to compound wealth over time. And if you need to understand, if you're going to be an active investor, this is going to be your reality. And, most of the time the market goes up, but there are periods where it goes down 30, 40, 50%. Okay. And those are opportunities to buy. But what happens is people get disillusioned and they sell, and then they swear off this compounding machine, this wealth creation machine on the left. So I thought this was great. This is from the Yankee nuclear power plant that was up in Maine. It got decommissioned in the 90s, I believe, like mid 90s, and they disassembled it. But this is the nuclear waste that's still stored there. And you can see the roads, you can see the little light poles and everything. This is the nuclear waste from the Yankee reactor for 20 years of operation. It's nothing. It's not even a football field. It's small. So you put a fence around it, you put it in these concrete casks. What people don't seem to understand is this, in the right situation with the right process and a certain price point for nuclear fuel, this can all be reprocessed into new fuel for reactors. So basically, this is a reserve of nuclear fuel that future generations will use. And the reason I wanted to show this is one of the canards that's out there from people that are either ignorant or have an agenda against nuclear power. Oh, what are you going to do with the waste? The waste is a big problem. What are we going to do with the waste? This is just one reactor. You just store it in a field with a fence around it in these casts and monitor it and have some security out there. That's what they have. What's the big deal? And again, this is an inventory of fuel that can be reprocessed and used in new reactors or as a MOX fuel or what have you. I'm not going to get into all the processes. I'm not an expert on it, but that's the point I'm trying to make. This is not a big deal. So when somebody comes to you and says, well, nuclear is, you know, what about what I've talked about before, that in the next 20 years, we're going to generate 47 million tons of solar panel waste. 47 million tons of solar waste, panel waste. What are you going to do with that? We've shown the pictures before of the blades from wind turbines that are no longer useful. Yes, there's some recycling happening here and there, but it's not, not 100% recycling. So they just bury them. Or if you drive out around West Texas, out in Sweetwater, where there's a lot of wind, you'll just see them stacked up in a field somewhere, rotting in the sun. So, you know, can you reuse that stuff? Well, they're, grinding up blades and using it for different things, but not all of them. And the same thing with the solar panels. There's a certain amount of recycling going on, but not sufficient enough for the tsunami of waste that's coming. And instead, we have this, well, I'm anti-nuclear because what are we going to do with the waste? This is the question, right? From the uninitiated, from the people that aren't educated. What costs too much? I was just reading the article about the U.S. now wanting to ramp up. I mean, Jennifer Granholm, the energy secretary, went to the recent nuclear conference and is basically begging people to build new nuclear. And it's even the CEO of Southern Company that built Georgia Power is a subsidiary of Southern Company, and they built Vogtle 3 and 4. He said that it cost a lot of money. They were over budget and late, and he's not really willing to go through that again. And that's why we need to understand why it was late, what the problems were, and fix that problem. Have the industry get with government and fix those problems. Was it a permitting issue? Was it reactor design and all of the oversight? Was it lack of qualified labor? What are the issues so that we can get this kick started? Because if we have China building reactors for 80% less, we're going to get left in the dust. I mean, the other countries around the world seem to have this down. And we're the United States of America. We built an interstate highway system. We, read about World War II and the manufacturing prowess of the shipyards that we had that were turning out. I can't remember the name of the companies, but they were turning out, one shipyard or group of shipyards was turning out one Liberty ship, which a Liberty ship was this big transport ship for transporting, armaments or troops a day. Okay. One of these things was being built not in a day, but the production was ramped up so that coming out of these shipyards, you had one a day coming out. And that was just one example of one company. And all, built like 20,000 bombers, I mean, so this has been done before. It can be done again. You want to talk about the space program thing. So if you focus and get smart people involved from industry, they can help solve these problems. And so if we want to do this, again, I kind of focused a little bit on the Doomberg, Adam Taggart podcast that talked about this. And Doomberg actually brought this up about the interstate highway system and that Eisenhower championed that and how it's transformational for the United States to the point that you can't even put an economic number on it. There's so many spillover effects and so much bonus from that it's hard to calculate how much, think about, as he said, think about what the U.S. economy would be today or the size of it or how it would be constructed if we didn't have that transport system. And so I think this nuclear, as the energy secretary said when she was at Plant Vogtle, 2 down, 198 to go. That could be transformational for the U.S., as I said last week. So this is one of the canards that people that are opposed to it will come up with. Again, it's not a big deal. It can be managed. This is not a problem and has not been a problem, the waste. So Niger withdraws French Orano's permit for its future mine that was to produce 5,000 tons a year for 35 years. So Orano takes note of the Niger authorities' decision to withdraw from its subsidiary its permit to exploit the deposit despite the resumption of activities on site. Pursuant to the expectations they had expressed, current market conditions with a favorable rise in the price of uranium make it once again possible to consider bringing Imararan into production. This being the case, and at the authorities' request, Orano had submitted a concrete technical proposal to the state of Niger, enabling this development to take place as quickly as possible. So I think what has happened here, a couple of things. A lot of people were sitting on their mining permits. They had been getting concessions and permits to mine uranium in Niger, and they were kind of sitting on them. I think because the market didn't really, prices were down for such a long time, they couldn't mine profitably. Now, the Niger government has changed. As we know, there was a coup. We have a anti-French colonial government there. They are already at odds with the French, want the French out, and Orano being a French company, that could have something to do with this also. What I'm getting at is, this was a mine that was going to produce 5,000 tons a year, 35 years. This is the kind of mine that we need to see come online. That's 13 million pounds a year of uranium, something like that. These are the type of mines that we need to see that are going to fix the problem. Not just this one mine, but, when is this mine going to come on? If Orano's out, who's in? Do the Russians come in? Does Kazatomprom come in? How long does that take then to get things ramped up? And so, again, we have more unknowns around uranium supply. And again, what we're seeing is this bifurcation in the world, this hegemon, the new upstart BRICS, Russia, China, what have you, at odds with the existing hegemon in the U.S. and its vassals in Western Europe. And this is partly some of the fallout here. And it's important because everybody's trying to go nuclear now, and we don't have enough uranium coming out of the ground in the time period that all these reactors are coming online. Again, there's no shortage of uranium. We won't run out of uranium. Who's going to commit the billions of dollars to develop? That's part of the problem I think these companies had. There's smaller companies there too that are being kind of challenged with their ability to get these mines online because access to capital. I don't see a lot of people lining up to give billions of dollars or hundreds of millions of dollars or what have you to bring these mines online. Now, maybe there'll be this big rush. I'm not aware of negotiations in the background, and all this stuff in Namibia is going to come online, and all these mines will come online, and this is not going to be a problem. But even if they started today and they all got financing just to get moving forward and get the materials, get the labor force straightened out, it's years. It would be years. That's why I remain bullish on uranium. Tavi Costa says it right here, 16 years on average to build a new mine. It doesn't really specify in this tweet, but you get the point, right? What's the tweet say? The global average time to build a mine has increased to nearly 16 years. The shocking aspect of these calculations is that they assume the macro environment we experienced over the last 20 to 30 years. Low energy costs, historically low interest rates, a more globalized environment, relatively low labor costs, low material costs. Punchline here, guys. We are currently facing almost the complete opposite of this situation. And so the mines are going to take longer, they're going to cost more, and they're going to be harder to do. And so that is my thesis for the super cycle. Demand, yes, is going to increase over time because of the global emergence of your global South and East economies and the people, 4 billion people there, 5 billion, however you want to count it. But that's going to have issues because the supply of materials is going to be constricted. Everybody acknowledges the underinvestment that's already occurred, and this is going to hinder a rapid increase in production. If you're talking about 16 years, I mean, that's a long time, right? So they recently had here's a John Quake's tweet, World Nuclear Fuel Market Conference in Atlanta. Uh, is there a potential for a sharp rise in uranium prices if Russia weaponizes supply as per their gas playbook? So this is what Vladimir Putin has already written, I believe, in his master's thesis, or at least when he was in university getting his master's. He talked about bringing Russia back after the collapse of the Soviet Union by using and accessing and using Russia's vast natural resources as a method to re-enter and re-engage into the world economy and to be a player. And so I, you know, I don't know what Russia's doing to weaponize it. The United States is performing ritual seppuku by banning Russian imports of uranium. Okay, well, this uranium that's banned from Russia is fungible. It will be used somewhere else. So you're not really hurting Russia. You're hurting yourself. Of course, we know about the waivers. Again, you can't have, it's the same idiotic people and policies that makes me kind of wince and kind of think that, yeah, we could be transformational in our thinking around building 200 more Vodal type plants and transform the US economy and be the leaders in nuclear power around the world. Okay. But then we go and do stupid stuff like weaponize, or not necessarily weaponize, shoot ourselves in the foot. The United States doesn't hardly produce any of its uranium. It has a history of uranium mining and produced tens of millions of pounds a year at one point, way back in the day. I think production last year was under 1 million pounds. And then the enrichment and the whole supply chain has been totally eviscerated, like every other industrial sector in the United States. We basically gave it away, shipped it overseas, and relied on somebody else. And now we're talking out of one side of our mouth saying we want to build 200 or 198 more 1,000 megawatt nuclear power plants, and yet we don't produce any fuel here in the United States. Plus the fact that it's a national security issue because we have a nuclear navy. Where are we getting that fuel from? And so this is a problem. So I don't think the main problem to worry about is this is why the United States really needs to put itself in check and look at really what it's trying to do and what is our long-term plan. What are we trying to do here? And this is why I'm not optimistic, because when you have these election cycles, 2 and 4 years, and you have 50% of the country hating each other, who's going to put this energy policy together that people are going to stick to over multiple administrations? You get the Biden administration in, we're going to have the Green New Deal or the Inflation Reduction Act, the gold rush into renewables. And now at the end of the administration, we're going to go shift to nuclear now because the memo came down from the donor class and the billionaire class, Larry Fink, the people at Google, the people at, Facebook, that want this Amazon, this AI revolution. They understand they're not going to be able to power these data centers with, intermittent power. It's too expensive and it's not reliable. And so the memo came down, and now all of a sudden we're nuclear again. You see where my consternation comes from? Now, as a citizen, yes, I can see the potential. As an investor and speculator, chaos equals cash. That's what a speculator does. Looks for government inserting itself into the free market, creating distortions. Those distortions then are tradable or investable. That's what a speculator does. So you see a tweet like this and you say, well, Russia could weaponize supply as per their gas playbook. Russia wants to sell this stuff. Whether you want to buy it or not is another question. Russia didn't blow up the Nord Stream pipeline. the United States and the UK likely blew it up. Isn't that amazing? Your European ally sits there with no, excuse my language, balls at all. You're telling me that Olaf Schultz doesn't have a clue? Nobody there in that government has a clue that the United States, did they know? Did the German government even know that their allies were going to blow up their main power source that powers their industry, the Nord Stream pipeline? They may not even known. And if they did know and were in on it, well, that's treason. But these are other conversations for another time. All right, guys, that's it for this week. Thanks for your support. Channel continues to grow. I'm getting a lot more interview requests. Why is that happening? I think because the information we give here is very timely, it's provocative, it's outside of the box thinking. This mostly comes from your support as we get more subscribers and more interest in the Actionable Intelligence Alert newsletter and in the videos. That's going to, create buzz. People are going to want to talk to me and get my views on things, because I think one of the things we offer is we're not always right here, obviously, because you can't be certain about the future 100%. But I think that we do offer some thinking that's not consensus. And I think that a lot of times we are quite a bit ahead of the curve, uh, and always trying to skate where the puck is going to be, vice where it's going currently. So I appreciate the support and look forward to talking to you soon. Thank you.